Good morning. You're watching All You Need to Know on BloombergQuint Live, and I'm Alex Matthew. First, the headlines. The U.S. Federal Reserve cuts interest rates for the third time this year, suggest it may pause on the rate cut cycle for now. A government-appointed committee has said that India's exports can grow at 10% annually, provided a wide range of steps, including easier labor laws and lower real interest rates, are assured. India is planning to open another 100 airports in the next 5 years as part of its plan to revive economic growth in the country. That's according to a source-based Bloomberg story. Reliance Jio hits out at the COAI's letter to the government seeking relief for incumbent telecom operators in the adjusted gross revenue case, says it does not represent the industry view by any stretch of imagination. And Indian Oil Corporation will be the only Nifty 50 company reporting its second quarter numbers later today. Let's talk about the big news first. The Fed. On expected lines, the U.S. Federal Reserve cut interest rates by 25 basis points. But the thing of note was the commentary, with the FOMC saying that it will only cut rates further if there is any material change in the economic outlook. Kathleen Hayes of Bloomberg News brings you this report.
The Fed really based, and Jay Powell repeated this today, they based these rate cuts on the fact that the U.S. economy was okay, worried about the global economy, worried about trade tensions. And today the Fed did cut the key rate 25 basis points, third time this year. That was expected. The big question is, what will Jay Powell signal about what happens next? And what he seemed to signal is we're going to wait and see. First of all, the policy statement dropped the pledge, quote, to act as appropriate to sustain the economic expansion. And then here's what Jay elaborated on when he talked at the press conference.
We see the current stance of monetary policy as likely to remain appropriate, as long as incoming information about the economy remains broadly consistent with our outlook of moderate economic growth, a strong labor market, and inflation near our symmetric 2% objective.
You know, Powell also said monetary policy is, quote, in a good place to keep the economy growing. Our Bloomberg Eco-Fed team in Washington is ready. A great story tonight where they're speculating. Is Jay Powell saying that the Fed has finally achieved that elusive soft landing, kind of Goldilocks, economy's not growing too much, not growing too little? Bottom line, the odds of a rate cut in December are down to about 1 in 5. Data will be watching very closely to determine what to decide about what the Fed does next.
All right, and perhaps also the macro data coming from the U.S. has played out in how the U.S. markets reacted. GDP numbers for the third quarter came out. 1.9% was the annualized rate of growth, and that was better than expected. What was expected in a poll by Bloomberg was 1.6%. And post the commentary from the Federal Reserve, the benchmark indices on Wall Street ended higher, and sentiment, as I told you, was also boosted by the better than expected economic data. All three benchmarks ended in the green, with the S&P 500 and the Nasdaq ending with 0.3% in the positive, and the Dow Jones climbing as much as 115 points. But for the fine print of what happened in that session, here's Renita Young of Bloomberg News with a wrap of Wednesday's Wall Street action.
U.S. markets ended higher on Wednesday after fluctuating for much of the session as the Federal Reserve cut interest rates by 0.25 percentage point, which was highly expected. However, policymakers said that they may hold off on further monetary policy easing throughout the year. Investors also saw more corporate earnings coming in. One of the latest companies to report was Lyft, reporting better than expected results, boosting its full year prospects and rising post-market. Another company report during the session was Johnson & Johnson, which lifted the Dow Jones Industrial Average, and Yum Brands, C.H. Robinson, and Molson Coors slumped after disappointing results. Facebook and Apple will also come very soon. And in other companies' news, PG&E is rising, canceling planned power shutoffs in part of California's wine country as wildfires continue to rage. Meanwhile, the GDP exceeded forecasts as the U.S. consumer stayed resilient during the latest quarter. WTI declined and the Bloomberg Dollar Spot Index also declined later in the session. And gold, however, paired some of its earlier gains, though ended the session just a little bit higher. And that's a look at your Wall Street action on Wednesday. In New York, I'm Renita Young for Bloomberg News.
All right, so let's also take a look at the Asian markets, at least the ones that have opened up so far. Rosalind Chin is joining us from the Bloomberg studios in Hong Kong. Good morning, Rosalind. So I would think that there's a fair bit of optimism following the comments from the Fed and also the rate cut, which came in as expected. How's it looking this morning?
You're absolutely right. Some of that optimism here really helping to buoy the markets in Asia. We've got the MSCI Asia Pacific making gains of 0.4%. And that comes, with a little bit of uncertainty creeping in about this US-China trade deal. Again, it just seems that with every step, there is something that's taking a step back as well. So this is after, of course, the APEC summit in Chile was cancelled because of the ongoing social unrest that's been going on in that country. So we are hearing that White House officials have been, and also the Chinese side have been looking for other alternative opportunities in which the two leaders can meet and discuss the trade deal. But still, markets are looking pretty much in positive territory this morning. Now, we've got Japan's Nikkei, that's making gains of about 1/3 in topic, so just about flat. We did have industrial output numbers showing that they rebounded more than expected in the month of September from a drop in August, although factory production did still fall over the third quarter. Here in Hong Kong, the Hang Seng Index is making gains of 0.7%. We are looking ahead to the third quarter GDP for Hong Kong, which is coming out later on Thursday. Now, of course, with this area has been beset by protests and, of course, the trade issues which have hit Hong Kong's economy pretty hard. We saw retail sales dropping pretty with a pretty big drop in August, down by a record 23%, and also predictions for retail sales to fall even further for the month of September. Visitor numbers have dropped, so we're really looking at a contraction of possibly 0.6%, which will be the second consecutive contraction for Hong Kong, and that would mean, of course, a technical recession. So those numbers will be coming out a little bit later today. In China, the market's open slightly higher. Shanghai Composite making gains of about 1/10%. The CSI 300 up by about 1/5%. And over in Australia, the S&P ASX 200 losing by more than 1/3%. The financials really leading those losses in Australia, and that's largely after, for example, banks like ANZ have announced their results. ANZ leading those losses, that is currently down by 3.4%, and that is after reporting a full-year profit, which stagnated. Back to you.
Thanks so much for that, Rosalind. Now, I do want to talk a little bit more about what Rosalind spoke about right at the start, which is basically about the trade talks between the US and China. US President Donald Trump's plan to sign phase 1 of the trade deal with China next month hit a roadblock after Chile cancelled the APEC summit, where Trump and Xi Jinping hoped to sign the deal. The White House, however, remains confident of signing the deal in the same time frame. Enda Karan of Bloomberg News brings you more.
Expectations are so high now that some kind of a deal will be done. The question is whether or not this is just a logistical hurdle and that both sides will agree on an alternative venue and push ahead with signing some kind of an interim deal in mid-November, or if in fact it becomes an excuse. A lot of observers watching this process have been saying, look, even the deal that they're talking about, which is China purchasing more goods, perhaps making some concessions around IP and on the currency, and the US holding off on extra tariffs, even the terms around those deals will take a longer time to work out than the mid-November deadline that people have been talking about. So the question becomes, will they use this APEC development as an excuse to put off the deadline and lower-level officials continue negotiating for some time until when and if they do sign off on an agreement? So I think it's somewhat up in the air. The expectations remains that both sides are pushing towards a deal and that they will want to sign it somewhere, but at the same time there's now an element of doubt in the whole process.
Yeah, and potentially that loss of momentum could be pretty damaging to sentiment, right? What now, in terms of a signal or response from the White House or from Beijing, would the market be looking at?
Well, I think, Heidi, to your very point about momentum, one would assume they were considering a plan B if they were serious about this, given the developments in Chile have been well known for some weeks now. So an early response from either Beijing and Washington to put alternative venues on the table, or a signal that they're both going to agree on some kind of a neutral ground, or in either country to sign this, would certainly soothe concerns and suggest that, look, both sides are on for this. We know that they have made progress in some of the areas I mentioned earlier, and we know that both economies are starting to feel some pain from this trade war, so there is a political imperative to get this done. If, on the other hand, the narrative emerges that both sides are dragging their feet, they're not agreeing on a venue, neither side wants to go through either side's suggested location, then we go back to that second scenario I mentioned earlier, whereby expectations might become we're in for a period of foot dragging here. We go back to lower level officials haggling on the details, and that mid-November deadline slips by.
All right, clearly we've already talked about several headlines, but let's see what else is making headlines across the globe. Sue Keenan of Bloomberg News brings you the first word headlines.
We start with Prime Minister Shinzo Abe. He has apologized to the nation after the Justice Minister, Katsuyuki Kaiwa, said that the second member of his cabinet to step down in a week. Kaiwa resigned after a tabloid magazine report made allegations that he was linked to illegal payments to campaign staff. He will be replaced by the former Gender Equality Minister. On to the UK now. Prime Minister Boris Johnson squared off with opposition leader Jeremy Corbyn in their first parliamentary clash of the election campaign. Corbyn accused Johnson of cutting funds for the National Health Service and planning to privatize it. Johnson said Corbyn would deliver an economic catastrophe for Britain and that a second Brexit referendum would ruin what should be a glorious year in 2020. On to Northern California now. More than 360,000 PG&E customers are still without power in California as strong winds fan more fires. The National Weather Service called an extreme warning for much of the southern half of the state through Thursday evening, with gusts reaching 130 kilometers per hour. At least 10 large wildfires are burning across the state, but the winds are expected to ease at the weekend. Global news 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Sue Keenan. This is Bloomberg.
All right, let's turn back to the Indian market now. Darshan Mehta is here to tell you all about the day's trade and also what's happening in the futures and options space. Good morning, Darshan. Well, clearly there's a fair bit of optimism from overseas because of the Fed decision, and that's borne out in the Asian markets as well. How are we looking at start today?
So it'll be a good start. For the past 4 days in a row, we've ended with a positive bias. We're seeing 30 points uptick on the SGX Nifty, which gives a positive view that's there. Even yesterday, the Nifty did well for itself, so there was traction that happened. The Nifty ended up almost 60 points, and the mid cap and the small cap end of the market did also manage to contribute. So it was a decent day of trade. The Nifty Bank was up in trade, but the star was the Nifty PSU Banking Index, and that was on account of SBI. They had an analyst meet yesterday in which a lot of positive commentary was given. Now, in terms of the ADR, Tata Motors continues to slide. It has seen its fair share of gain. Vedanta was down in trade, and ICICI Bank was down in trade. Infosys managed to stay flat in trade, but most of the other ADRs came off close to 1%. As far as flows were concerned, FIs were net buyers to the tune of 7,000 crores. But remember, this also includes the big block deal that happened in HDFC Life, and Capital was one of the big buyers. They bought in 5 crore shares of the 10 crore shares. So a lot of foreign funds have bought into that. So this number will include the HDFC block deal. DIs were net sellers to the tune of 186 crores. The other factors is how did the Nifty pan out in trade? We were up 57 points. TCS, Reliance, both of them contributed positively. Infosys and ITC were the other ones. Surprisingly, after hitting a 52-week high, ICICI Bank cooled off in trade yesterday. Bajaj Finance, Maruti Suzuki and IndusInd Bank were also weak. Remember, today is the expiry for the month, so let's see how the expiry looks at. If you're looking at the rollovers, close to 53%, 75% build up on the November series. Let's take a look at the Nifty Bank and see what happened in trade. So that one was also seeing decent rollovers at 45%. Let's take a look at some of the other factors where our positions being built. We are close to the 11,900 mark in trade. So from 11,800 to lower level, put writers are becoming much more aggressive, and at higher level, call writers are writing. So 11,800 11,800, 900, and if the market manages to continue 11,800 and 11,900, the call writers will have to shed positions in open interest, and that was also seen in trade yesterday. 11,800 put so high open interest built up, but the market indication is positive, and at lower levels, since the premium went up significantly, call writers were forced to shed positions in open interest, and that is why even the PCR also went up. So the VIX didn't move much; it was up 1.45%, but the Nifty PCR probably must have gone up. So it was at 1.48 across all the series. Remember, it's expiry today, so it'll be interesting to see. Some of the counters in focus. Grasim moved up almost 3%. It fell because of the Vodafone news that came out on Bloomberg, and after the clarification by the management, managed to move up. Britannia was down in trade. Bosch is at almost was flat in trade, but the other counters also in the cement pack saw a little bit of action that came in. So basically, that's the trade setup.
Thanks so much for that, Darshan. All right, let's talk about the banking space now. Have you been getting more calls from banks lately asking you whether you wanted a credit card or whether you want a personal loan? Well, that is fine, but the fact is, and it turns out, that faced with a slowing economy, lenders are increasing their focus on customers with lower credit scores in order to maintain growth rates. That's according to a study by credit bureau TransUnion CIBIL. Pallavi Nahata has more details about this study in this report.
As economic growth slows and consumption weakens, banks and NBFCs are lending more to higher risk borrowers, according to a study conducted by TransUnion CIBIL. There's a rise in the proportion of personal loans and credit cards given to consumers with lower credit scores. For instance, while new personal loans rose by 30.8%, this growth was accompanied by a marked shift in new loans to near-prime and subprime borrowers. Near-prime borrowers are those with credit scores between 650 and 700, while subprime borrowers are those with scores between 300 and 650. According to the report, 44.8% of new borrowers during the quarter ended June 2019 were those categorized as subprime and near-prime. This compared with 36.4% for the same quarter in the previous year. In the case of personal loans originated by NBFCs, almost half were to borrowers in below prime segments. This was an increase of 8.5 percentage points over the quarter ended June 2018. A similar trend also persisted across credit cards. In Q2, 32.1% of new credit cards were issued to consumers in the near-prime and subprime categories, compared with 26.4% a year ago. Overall, the number of new credit cards issued rose by 30.2% and pulled up the total number of active credit card customers to 27.7 million for the quarter ended June 2019. Outstanding credit card balances came close to the rupees 1 lakh crore mark, led by strong origination volumes. Delinquencies in these segments have improved modestly so far. While unsecured lending continued to grow, driven by riskier lending, sluggish passenger vehicle sales, and affordability constraints in housing, limited credit growth in secured lending. New auto loans originated during the quarter increased only by 7.7% over the same period last year. Even here, originations from borrowers in below prime segments rose to 37.4% from 33.1% a year ago.
All right, now political ads form only 1% of the revenue of Facebook, and it's probably not worth the controversy that it invites. Yet Facebook COO Sheryl Sandberg says that the platform believes in free political expression. In an exclusive interview with Bloomberg Television, Sandberg spoke about investing more in ensuring political transparency going ahead. Listen in.
This is a controversial decision. As Mark just said on our earnings call, we're not doing it because of the money. This is less than 1% of our revenue, and the revenue is not worth the controversy. But what Mark said is that we believe in free expression. We believe in political speech, and ads can be an important part of that. Where we're really focused, and I think we are leading, is on transparency. We put out an ad library. We now announced a presidential ads tracker, which means that you can see any ad anyone is running who's a political candidate anywhere in the U.S. anywhere in the world, even if it's not targeted at you. And that kind of transparency we think is really important to people understanding. You also talked about investing in protection. One of the things we talked about on our earnings call just now is the size of the investments we're making, prepared for 2020, working with election commissions all over the world, hiring engineers, using machine, using human reviewers, really doing what we can to make sure people are kept safe.
So when Twitter decides to go the opposite direction, does that make you question your own decision, or you still stand by the fundamental reasoning and transparency that you can bring?
Well, Mark has said on the call that, we've thought about this for years, and certainly we've been thinking about it now. And we fundamentally believe that political ads are an important part of the dialogue and can be important against incumbents, can be important for new views. But we also believe that free expression across the board is something that we stand for as a company. And people all over the world are using that. Certainly politicians are using that. But people are using it, and that's how you see our growth continuing.
Let's talk more a little bit about politicians, because it's going to be a tough year in terms of regulatory scrutiny. Do you worry about talk of the business model being under attack? How do you see your role in educating, particularly those on Capitol Hill, about this?
Well, I think we really have to help people understand that targeted ads and privacy are not at odds. We can do both. So if you're an advertiser, you're the biggest company in the world or the smallest company, and we have 7 million advertisers, 140 million businesses using our services, and you want to show an ad to, women in their 50s, that's me, who live in California, we take the ad, we show it to that person, we give you back aggregated results. We can do very good ads targeting that really makes ads good for people and really helps advertisers reach the right person without violating privacy. And that's something I think we need to do a much better job of explaining.
What do you think about political advertisements on social media? Let us know in the comment section. But meanwhile, let's turn to other news, or rather earnings. The country's largest oil marketing company will come out with its second quarter numbers today. And while IOC is expected to report healthy marketing margins, the sudden drop in crude oil prices will lead to inventory losses in the quarter gone by. Somit Sarkar is here with the fine points and the details. Somit, what are we expecting? What are the key numbers to watch for?
Well, I'll start off with the key numbers first. The revenues are expected to be down by nearly 8%. EBITDA is expected to be marginally down by nearly 1% to close to 8,279 crore rupees. The margins are expected to come in at 6.8%, while the net profit of the company is expected to be higher by nearly 3% to close to 3,700 crore rupees. The gross refining margin, as the key number, is expected to come in higher at $5.1 per barrel. Now, a stronger refining and marketing environment will lead IOCL to report a strong quarter, but however, some of these positives will be offset by inventory losses and tepid consumption growth that we had seen in the second quarter of financial year 2020. Now, the Singapore gross refining margin that averaged at around $6.5 per barrel versus $3.5 per barrel, because of which the refining segment is expected to report a strong number. And on the marketing side, if you see the gross marketing margins earned by Indian Oil Corporation on sale of every liter of petrol and diesel, that also averaged higher at 3.4 rupees per liter and 3.7 rupees per liter. Now, marketing margins were higher compared to last quarter, because in first quarter of financial year 2020 there was election time, because of which the marketing margins were subdued for the oil marketing companies. And if you see the Brent crude, now that averaged around $62.12 per barrel versus $68.52 per barrel in the last quarter. Now, crude prices jumped the most in the second quarter, but the gains were short-lived, and because of this fall, the oil marketing companies, that is Indian Oil Corporation, is expected to report an inventory loss as the average crude prices were lower compared to last quarter. Now, crude throughput, that is expected to be higher by nearly 5% to close to 18.1 million metric tons, while the sales number are expected to be down by nearly 6% to close to 20.4 million metric tons, and that is because of a tepid consumption growth seen in the second quarter of financial year 2020. On the EBITDA side, there's a marginal decline that is expected to come in because there were some one-off adjustments in the first quarter, and that's the reason the net profit growth is also lower at 3.3%. Also, some foreign exchange losses are expected to come in for Indian Oil Corporation in the second quarter, while the petrochemical business is expected to report a weak number because of lower petrochemical product spreads in the second quarter. Now, the key things to watch out for from Indian Oil Corporation earnings would include the gross refining margins and the marketing margin outlook of the company, their inventory and foreign exchange gains, petrochemical performance, and gross debt and the subsidy dues from the government would be important to watch out for Indian Oil Corporation in quarter two earnings today.
All right, Sumit, clearly we have to watch out for IOC in trade today as well, but what are the other stocks in the news? What's on your list today?
Well, I start off with earnings. Container Corp, with the results were largely in line with analyst estimates. There was an exceptional loss due to discontinuation of export incentives. That notification and earlier comment which the company provided in this quarter, and that's the reason the company has reported a net loss. Now, the volume decline was offset by stable margins and realization growth. Now, volume growth was down nearly 2% as EXIM volumes remain subdued. So this will put in question the company's guidance of 10 to 12% for FY20 that it had given earlier. So we'll have to watch out for that in the conference call that is held today. Tata Global Beverages results were largely in line with analyst estimates. The profit was impacted by lower other income, which fell nearly 64% compared to last quarter. India tea business volume and value growth was at around 8%, which was the key positive in this earnings. Along with this, plantation and instant coffee business showed some strong growth. International coffee and tea businesses was operationally strong, but the revenue numbers were weak. The cost rationalization measures and Ind AS impacted actually aided the margins in the second quarter, while the company also said that the merger of consumer product business with Tata Chemicals is currently on track. Credit Access Grameen, when the net interest income was up 23%, net profit increased by 37%, asset quality remained stable, while the gross loan portfolio was up nearly 36%. Also, the company announced that the chairman and independent director, that is MP Gopinath, has resigned from its post. JK Tyre Industry, where the net profit jumped on the back of a deferred tax reversal, margins were aided by lower other expenses and lower raw material costs. Raw material as a percentage of sales was down at 58% versus 63% last year. Quest Corp revenues were up 27%, net profit declined by 2%, but the EBITDA of the company that was higher by 44%. Higher finance costs and depreciation costs impacted the net profit of the company in the second quarter of financial year 2020. Lastly, Cognizant Technologies, on the result side, the results were largely in line with estimates, and the company also raised its lower end of guidance. The other stocks to watch out for would include SBI, where the bank had held an analyst meet, and in the analyst meet, the management said that they're guiding for that the management guided for a strong second half of financial year 2020. The management also confident of sustained improvement in its core operating performance. Now they're seeing improved asset quality given the balance sheet strength. They're also prioritizing and focusing on credit quality that will impact its growth, and they also focus on the subsidiaries like SBI Cards IPO to be the key focus and the catalyst for SBI. Lastly, the management also said that they plan to lift the return on asset to 1% by financial year 2021, which will be mainly aided by credit costs and improving operating profits of the company. Intellect Design Arena, where they signed a multi-million deal with UK's Commonwealth Trade Bank for digital transaction. And lastly, a key bundle that happened yesterday on HDFC Life Insurance, where the promoter Standard Life sold nearly 10 crore, so that is 5% stake. One of the buyers for this was Capital Group, which acquired nearly 2.5% stake in the company.
All right, well, catch your breath, Sumit. That was quite the long list. Thanks so much for that. If you missed any of that, you can find it on the website BloombergQuint.com in the story that is named Stocks in News. There's also several other stories that you'll find on the website. Let me take you through a couple of them. Reliance Jio Infocom has come out and criticized a letter by industry lobby Cellular Operators Association of India, which urged a government panel to suggest relief measures for the sector within 2 months. In a strongly worded statement, the company said, and I quote, "We take strong umbrage at COAI exploiting legitimate payout obligations to create an alarmist propaganda for the doom of the telecom sector in the country," unquote. In another story, the government is planning to open 100 additional airports by 2024 as part of a plan to revive economic growth, according to a Bloomberg report that quoted unnamed sources. The proposal, which includes starting 1,000 new routes connecting smaller towns and villages, was discussed at a meeting last week to review infrastructure needed by 2025. Steps to start a plane leasing or lease financing business in the country was also discussed. All right, that's all you need to know going into trade today, but do stay tuned. Of course, there's a lot more coming up over the course of the day on Bloomberg Quint. Thanks so much for watching.